Welcome to Pride Partners International's monthly webinar. Thank you for joining us today. Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting. Our transmission will begin shortly. We invite you to participate actively by sending all your questions or comments through the live chat. Again, thank you for watching, and we hope you enjoy the event.
Hello, my name is Uday Ved. I'm a chartered accountant and partner with KNAV. Good evening to all our friends in India. Good morning to our friends in USA, and good afternoon to people in Europe. I want to first thank Pride Partners for giving us this opportunity to speak on a very important subject on the international tax, which would be of relevance to the entire audience here. So thank you, Pride Partners, for that, and thank you to my Pratik Manani, my colleague, who helped in entire coordinating this event. We have some interesting topic to cover, and I'll go straight into the subject. What we are going to discuss in next about 40-45 minutes is going to be on this OECD and G20's initiative on the two-pillar approach, which has been unveiled, the BEPS, the Base Erosion and Profit Shifting initiative, which impacts international taxation all over the world. We'll also speak something about the permanent establishment attribution issues and link it to transfer pricing. I know that this organization focuses on the transfer pricing, and TP would be of a lot of interest to all the participants here. Can we move the slide, please? Are we able to move the slide, please? Yes. Just before getting into the subject, let me just introduce an interesting panel, part of our firm. As I said, my name is Uday Ved. I'm a partner in international taxation with KNAV. I have my colleague Hetav Vasani, who is a senior manager in transfer pricing, focused a lot over last more than a decade and brings huge experience in transfer pricing. Pratik Manani, again a manager with our firm in the global transfer pricing practice, brings substantial experience on the transfer pricing in USA and other parts of the world. Rutuja Soni, who is our manager in international taxation and focused a lot on BEPS in Pillar 1 and Pillar 2. And of course, my last colleague, Jainesh Nahar, who is a part of our transfer pricing team within KNAV and done huge amount of work in the context of TP, including the practical implementation in India. So with this panel, we'll go straight to the subject. Can we move the slide, please? So interestingly, when we talk of transfer pricing, it is always first we talk about the international tax and the permanent establishment. The P and the transfer pricing is linked together globally. The entire concept of tax avoidance, tax evasion, everything is developed over years, and globally, the OECD and G20 took this initiative in introducing the two-pillar as a part of inclusive framework. So we have about 137 countries out of 141 countries who have signed Pillar 1 and Pillar 2 on the BEPS, which talks essentially of the issues arising after digitization of the economy. So as we are moving in last 1 decade, a lot of physical business is moving into the digital business. And the initiative was taken by the OECD and G20 after the BEPS was unveiled in 2015 in terms of how to tax digital economy. Before taxing the digital economy, the panel and the OECD and G20 actually studied various business models. And we have reports which have been unveiled over last 5 years. And we now have a final report on Pillar 1 and Pillar 2, where there have been a lot of disruptions which have happened, and disruptions continue even as we talk today, and it will continue in the future also. So technology related aspects are very relevant. And when one looks at the tax treaties generally talk of the physical presence, right? And so a company like Amazon or a Google will operate out of a server somewhere outside India. They don't need any physical presence in India. They don't have any office, no employee, no nothing. And so the tax treaties generally don't have this kind of aspects being covered. And this is exactly what is being trying to covered by the Pillar 1 and Pillar 2. Of course, when it comes, once we talk about the Pillar 1 and Pillar 2, we'll talk about once the PE is established, let's assume under the digital economy. As far as physical economy is concerned, we already have Article 5 under the treaty, which talks about physical fixed place of business, office, warehouse, service P, etc. And we will have a P as far as digital is concerned once the rules are being formulated. And a lot of work has happened over the last 3 years. It is still evolving, and we'll see that in the time to come. And P attribution versus arm's length principle, and the basic principle of transfer pricing is arm's length. We will also see some recent transfer pricing trends and developments in India. We have a TP law, which is part of the Income Tax Act for last 20 years now in India, and a lot has developed. It is based on the global OECD law, and it has developed over last 1 decade much more. A lot of disputes were happening in the past on transfer pricing. India, no exception, and we have seen the administration has become really easier. We'll also see the transfer pricing trends and developments in USA, particularly a very developed country in the world, as a TP law for more than 40 years. And we'll hear something on the recent trends which is happening. We'll also talk about some key transfer pricing issues and challenges which are arising for multinationals as we talk today. And of course, managing transfer pricing risk is very, very important, right? And how the transactions are structured, what kind of risk arise, because of that, what P issues arise, and how do you manage that taxes is what we'll try and cover as a part of that. Next, please. Let's just focus before we go on a Pillar 1 and Pillar 2, if we can look at a little journey of how it has evolved over a period of time. So interestingly, OECD and G7 at that point of time in 1996 is almost 25 years plus, looked at the problems of tax evasion and tax avoidance. And it set a priority to set it right, because as far as multinationals are concerned, it does not matter where the profits are parked, because it is owned by a parent, say in USA, and it has subsidiaries all over the world. So it makes sense for them to transfer profits in a low tax country or tax haven, as used to be called in the past, and then repatriate the profits as and when needed. And so in this example, if the profits were never repatriated, USA would lose the tax. And so the question of tax avoidance and tax evasion came at that point of time, and we had the harmful tax competition report, which was being developed by OECD at that point of time. Since then, we come a long way. And in 2010, 2011, when the Starbucks happened, many of you may know, which said Starbucks had huge business in UK, right, but paid practically nil tax in 2010-11. And the question of morality of tax came, whether legally they structured in such a manner that they had subsidiaries in Luxembourg or in Ireland at that point of time, which paid no tax in UK. And then the question came, how do you fairly allocate profit and fairly allocate tax so that countries which actually produce or where the value is created should get the fair share of tax. And that was the evolving or beginning of the BEPS regime, the base erosion and profit shifting, which happened. The OECD and G20 took this initiative, and we had a first 15 action points being announced in October 15. And I would say since now it is almost the 7th year, the BEPS has been a great initiative, and number of countries all over the world, India has been at the forefront, has implemented a lot of parts of this in the domestic law. Because the question which came at that point of time, that there was a report which was being produced, but this association was a loose association. It does not have a legal sanctity. So unless the domestic tax rules were changed, you could not implement that. And many countries implemented. India was at the forefront. It also made a lot of changes on the transfer pricing, particularly, which is relevant here. If you look at Action 8 to Action 10 of the BEPS report, which talks of the transfer pricing, harmful tax practices, number of tax treaties were changed. We had multilateral convention, which came out a year later. And because of that, number of tax treaties were changed, like in India, Mauritius, Cyprus, Singapore, these treaties were changed because of the multilateral convention. And then the group focused, as they call the inclusive framework, on the BEPS Pillar 1 and 2. And we have in last year, which was in October of 2021, where OECD and G20 issued a statement on Pillar 1 and Pillar 2, and we'll talk about it as we go forward. It is still a work in progress, and the implementation will take a couple of years. The earliest it can get implemented is 2024 or 2025. We will see whether it is going to be implemented or not. But just thought I'll give you a broad overview of what has happened over last 25 years, so that we now focus on the topic that we are talking. Next, please. So let me pause here and ask my colleague Rutuja, who has dealt a lot, done a lot of research, done some practical assignments in last 12 months, on what she believes on Pillar 1 and Pillar 2. Rutuja, your take on this briefly on Pillar 1 and Pillar 2, please.
So thank you, sir, for giving the introduction about Pillar 1, Pillar 2. Good evening and good morning, everyone. Thank you for giving the opportunity to share the thoughts with all of you. So as our senior partner, Mr. Udayved, has already mentioned, the foundation stone for the two-pillar solution had been laid in October 2021, where the landmark deal on the global minimum tax with OECD, it aimed at that the company should pay a fair share of their taxes wherever they operate and generate profits. So the program for the work to be conducted on the Pillar 1 and Pillar 2 was adopted then later in 2019, and G20 in 2019, they came up with a report. At the July 2021 G7 meeting, it was announced that a broad agreement on the international tax reform will be reached, and on the inclusive framework members on a two-pillar plan to combat on the global profit shifting and the base erosion, which is normally called as a BEPS. So as already the context has been placed by Mr. Udayved, that the formal recognition by the OECD has taken place that the existence of global tax suffers from the two fundamental infirmities. So one is there is in the digital platform, there is no fixed place of business. And second is the profits are not merely arised from the research, manufacturing, the production, but also on the demand and supply, which is nothing but access to the markets. So whilst the Pillar 1 provides a mechanism to allocate the profits among the market jurisdictions, Pillar 2 imposes a minimum tax of 15% on the corporates in all the countries. For example, businesses such as Google, Amazon, Facebook, they do not require any physical presence, as they are working digitally in all the countries on the market jurisdiction basis. Thereby, the current tax framework, which has already been taken place, such entities are not typically taxed in absence of the taxable presence in that specific market jurisdiction. To cover all these M&Es which are having high profits, so they should pay the fair share of profits to such market jurisdiction. I'll give you a very simple example here. Let's take an example that in England there is a T20 World Cup, and there are jerseys which cricketers normally wear. Those jerseys are being sold normally at the rate of, let's say, 100 per dollar. Now, if England wins or England comes in the final of the World Cup, so on the previous day of the World Cup, these jerseys will get sold, let's say, around USD $200 or $300. However, if England loses in the first match itself, these jerseys which England cricketers play wear and then they play, those will not get sold even for 10 USD dollars later on. So these are not basis the product or the quality of the product. So the pricing is based on the market duration, and that's why the OECD came up with Pillar 1 and Pillar 2 to arrive at a solution so that market duration takes place. So just to give an example for this Pillar 1, what is Pillar 1? It's nothing but a formula-based approach for these certain markets which are demand-driven markets. And these are new taxing rights beyond the arm's length principle, which has already been taken place by way of a treaties which the entities have entered, which the countries have entered with each other. Now, how to calculate this value for taxing these rights? So everybody is asking OECD without getting into country specific. The OECD has come up with this particular Pillar 1 amount, which the progress report has been released very recently on the amount A. What it states is, it states that the almost on over $125 billion of the profits combined with all these M&Es, which are so-called in the scope of work for this Pillar 1, having these M&Es are in the scope which are having global turnover of about $20 billion. So these are the M&Es which are now new tax rights confirmed to the market jurisdiction. How these profits will get allocated, attributed for these rules have been already taken place. Now, with respect to the Pillar 2, which is the highlight very recently, everyone is talking about the Pillar 2. Many countries have taken certain towards that directions, implementing minimum tax rates in their legislations. So there is a thrust by the most of the players, particularly the emerging markets, to have a Pillar 2 in place rather than Pillar 1. Specifically, if you take an example for USA is putting a lot of thrust on implementing Pillar 2 rather than implementing Pillar 1, whereas developing countries like India, Asian countries, they are putting a lot of efforts and focus on the implementation of Pillar 1. So because they are the ones who are having the market jurisdiction, and they would get a fair share of tax in those countries. Can we move to next, please? Yeah. So as I already mentioned, the amount A is the new taxing right, which is beyond the arm's length principle, which will be driven in case of Pillar 1. And there will be allocation of the portion of deemed residual profits to these market jurisdiction using a formula option and formula approach. Amount AB is something which is expected to be coming in end of the 2022 or the earliest start of 2023, which will have the fixed baseline return for the marketing and distribution divisions. So so there will be a fixed return, and there will be something more than that which will come in amount A. So these are the two parts of the Pillar 1. What is tax certainty? So tax certainty is something where there is a progress report which released on October 6th, which talks about tax certainty. So there is an effective dispute prevention and resolution mechanism in place, applicable for all the businesses, all the M&Es, entire world, where the tax certainty approach has to be followed. Just let me tell you, Pillar 1 is something, if it gets implemented, it will be a mandatory, whereas Pillar 2 in place, it's a optional given to the country specific whether they want to opt for or not. As we have a MLI already as a BEPS Action Plan 15 in place for the treaties in the countries, there is a multilateral convention and the explanatory memorandum which will be coming up as a part of the Pillar 1 and expected to be released by 2023. Can we move to next, please?
I think
As I've
Rutuja,
already-
you covered this, I think. Scope
I've
and
already covered this. We can move
if-
to next. Yes,
Yeah,
thank you.
yeah.
So in the Pillar 2, I just take 1 minute to just what is Pillar 2. So Pillar 2 is focused on the global minimum tax. It's intended to address the remaining BEPS issues. What are the BEPS issues? Which is elimination of tax havens, addressing issues of harmful tax competition, ensure the coherence of international tax rules, and the transparent tax environment, which all the countries would like to have. So these there are the mechanisms, little complicated and the complex, but they are the mechanisms in place to ensure that the tax is paid, and there is a common approach which has been followed to have a global minimum tax rate of 15% for all the MNCs which are having turnover of more than euro 750 million. So this is applicable to all the MNEs only where the annual revenue for them is euro 750 million. And Pillar 2 primarily consists of the two interlocking domestic rules. One is STTR, which is subject to tax rules, and income inclusion rules, IRR. Under tax payment rule is applicable when a country do not opt for the Pillar 2. So just to give a heads up on the key issues which the Pillar 2 has is, there are guilty provisions in the USA. So people are discussing whether guilty provisions in USA would qualify as income inclusion rules or not. How to align the accounting policies and the data maintenance by the business organization. How the tax credits and the corporate losses will get set off in the era of Pillar 2, and how to establish a globally aligned transfer pricing model for all the entities of these MNCs in place. Can we move to next, please? Yeah, so as I've already covered here, the threshold limit is 750 million annual revenue, and the profit is, there is a profit shifting. If there is any profit shifting of low tax jurisdiction, that will get covered by Pillar 2.
Good.
Can we move to next, please?
So thank you, Rutuja. I think this is a very complex subject, and you covered it very well within the short time. And the objective was to just give a flavor of Pillar 1, Pillar 2, which is actually linked to the transfer pricing and the permanent establishment. As Rutuja rightly mentioned, the Pillar 1 talks of the P attribution, how the profits will be attributable to the market jurisdiction. So with that, let's move. Heta, why don't you just speak about the traditional P attribution and to an extent the formulaic approach that Rutuja just mentioned about it, and how does the arm's length principle work vis-a-vis? As an example, there is no dramatic shift from what the transfer pricing was attributable in the past for the hardcore economy. But certainly when it comes to the digital economy, there would be a shift. I would request Heta, why don't you give your views on this, please?
Yeah, thank you. Thank you so much, Udayvid sir, for the kind introduction. And thank you, Rutuja, for sharing your thoughts on Pillar 1 and Pillar 2. So before we jump into the profit attribution to the PE, we shall first understand the concept of PE and the types of PE. So though the topic of PE is very vast, but due to the paucity of time, I shall just speak for a few minutes on each slide, and I'm happy to take the questions offline. Next slide. Okay, so as each country has a right to tax its entity on the basis of the residential status, so in the same way, even the source country has a right to tax from where it carries out its revenue generating activities. So here arises the concept of a PE where the non-resident is taxed in a source country. Now the question which will arise to everybody's mind is whether all the non-resident are taxable. The answer is no. Only those non-residents which has a business connection in the source country will be considered as the PE. Now, this essentially means that the transacting in a country will be tested to decide on the PE and not the transacting with a country. So that's like a demarcation line to decide what is PE, what is not a PE. And the entire agenda of the double taxation avoidance agreement is to avoid the double taxation. So thereby, when a PE is taxed in a source country, it is very much justified for a resident country to give a relief for such taxes which are paid. Now, next, when the PE is alleged or PE is accepted by the taxpayer, then what? Then there lies a series of compliances that may be required to be fulfilled, and transfer pricing is one of those. Next slide. Yeah. So, what are the types of PE? This will be purely basics and not in detail. And our idea is just to talk more on the attribution. So first is a fixed place PE, which even Uday sir set a context really well. So this means that there has to be a commercial and a geographical coherence. It should have some degree of permanence in that place. And if there is a revenue generating activities, it is called as a PE. So what are the exceptions for that? Exceptions as in if I do kind of a storage activity, display, or a delivery, then there is no PE. But yes, there are certain even exceptions that even if a shorter duration covers the entire assignment, then it can be construed as a PE. So the activities that are not of my core business, so they are essentially exemption. For example, I have just mentioned is a preparatory and auxiliary nature, so there is no PE. Second is the agency PE, and this is worldwide known terminology. There are two types of agents. One is dependent, another is independent. Who are the dependent agents? So a person acting in a source country and which has a sufficiently authority to bind his principal, and he is habitually exercising such authority. They are the dependent agents. And who are non-independent agents? Independent agents are those who are excluded from the PE. And why so? Because they are financially, economically, and legally independent. Dependent agent is someone who is making his principal bind. That is why it is a PE. An independent agent, they are independent in all terms. They have even their own business, own client, and they are not exclusive to the principals. For example, insurance companies, they take and they sell the products of all the insurance companies. They are not independent, and hence they're excluded from the PE definition. Fourth is the installation or construction PE. Pretty simple. Building site, laying of the pipelines, the installation of the equipments, even dredging activity, is covered, because anything to start the construction, it requires a planning, designing. So even that is considered as a part of PE, and even the period of that is covered as a period to consider for the PE activity. Last is the service PE. Service PE is something which has advanced in near term, which in case of the foreign enterprise or a non-resident, render services in India through employees or other personnel. And one thing to keep in mind is these are not the fees for technical services, because there is altogether a separate article for that. So if the duration of such services in India exceeds a threshold limit, so generally this kind of a treaties provide a threshold, say for example 90 to 120 days for the unrelated parties, for which it can be construed as a PE. For related parties, the exemption limit or probably the period for a prescribed period is less than, say, even 1 day. 1 day to 30 days can also be considered as a PE. So if such services are rendered to associate enterprise, say from 1 day to 30 days, depending on the treaty with a country, it can be construed as a PE. An example could be a provision of a management and a consultancy services, etc. Next slide. Okay, now here is a very important slide on attribution. What is attribution? Attribution is something which is linked to the profits and for which the entity of the source state is supposed to pay taxes to the government. Now there are broadly three kinds of apportionments which I have provided in the graph also, starting from ad hoc approach to far-based approach. Now, I'll discuss briefly on these apportionments, and then in the next slide, I will briefly speak about what the Indian government, CBDT, has laid down the foundation to even come with altogether a different formula. So before jumping into something which may come as a final rules, which are yet a draft rules, before that we discuss about the primitive techniques, which are still going on, which still the taxpayer is fighting at the tribunal levels over here in India. So the first one is pretty simple. It is a attribution that is linked to the ad hoc kind of the activity. For example, like, no formula, but just on the basis of some rationale or judgment, certain profits as a percentage of revenue is estimated and attributed to that PE. So this can also be called as a presumptive method. No logic is applied by the tax authorities. They simply put some kind of formula and they do the adjustment. With the advancement, there came another approach, which is a formulatory approach or apportionment. Here, the proportionate profits are based on the world income. P is into losses in India, no problem. But if world is making profits, that part of profit should be attributed to India. Something basis of a scientific formula. Many plethora of judgments, say Rolls-Royce case, 35% of the global profits, Motorola case, 20% of the global profits. Purely scientific formula, no FAR analysis, nothing. Coming to third approach, which is the authorized OECD approach. It relies on the concept of the significant people functions to determine the activity which is attributable to the PE, taking into account the functions performed, asset used, and risk assumed by the PE. As far as India stands, it does not accept or agree with the authorized OECD approach. Why and how, we'll look into next slide. But in sort of India not agreeing to the demand side, what is attributable in case of FAR analysis, then there is something which is called as a CBDT, a new apportionment, which I'll talk in the next slide. Okay, so now let's understand the new type of apportionment, that is fractional apportionment. Now, why such type? The first reason is there was a lack of a clear guidance, computation mechanism, leading to disputes and litigation. It was therefore considered essential to undertake necessary measures to bring clarity, consistency, and practicability in the domestic attribution rules that are permissible under the treaties. What can be the second reason? India has expressed its reservations, like I spoke in the initial slide, on the OECD FAR model, which has ignored totally the demand side factors. Now, developing countries like India are mostly the net importer of capital and technology. And that is why there are chances that if we at all apply the FAR analysis approach, there is a substantial loss of revenue to the government. Now, while everyone here agrees that the multinational can freely decide where to locate production and thereby shift profits, however, important point is the decision as to where the demand will be more to serve their customer is far less flexible. So decoupling the profits from the investment location and linking profits to the point of sale will be the solution to the problem of tax. This is more in lines with the OECD Pillar 1, which my colleague Rutuja and Udayvet sir spoke well. Next slide. Now this is a last slide and I'm not going to spend much time, but here is a slide where a professional partners who are present here in the session and even the tax heads can bring forward this issue, help each other and be aware of the PE exposure so as to avoid the situation wherein you pay more taxes to the government even when there is no PE. So with the digital economy, like Udayvet sir mentioned, concept that is emerging, even OECD Pillar 1 coming into implementation, due respect will be given to the profit attribution where user base lies. The concept of farm, FARM, has evolved where M stands for market, and now FAR is bit a traditional, it seems. Now there are few 3-4 mitigation steps or probably 3-4 mitigation issues which we will speak into, and then I'll end my session. So first is the subcontracting arrangements. Like, many times it so happens that a contract has been awarded to a foreign enterprise who subcontracts a part of the job to the local subcontractor. Now, the issue where arises is that while the computing the project duration to satisfy the PE test, the time spent by the subcontractor on the site project should be counted for the purpose of the calculating the presence of foreign enterprise in India. So this all sort of issues my partners over here and a tax head should be aware to avoid the PE status in any of the country, especially I'm talking about India. Second and third situation is related to very important about the key management personnel or the executives who do the supervisory leading role sitting in the entity, or probably based out of the location where the substance is required to be created. For example, of an entity which I'm talking about is my past client, where the entire entity was driven in India, but only few employees were present in USA. So when there was a merger acquisition proposal which came to US entity, we gave them the exact idea what is happening in India, what was happening in US. And we observed that the US was overvalued, and because of which the entire deal was called off. And the last which I'll speak about is on the documentation, which is very important. So when you have the subsidiary which is based out of in US and prepare the FAR analysis of the documentation should be in complete sync with what FAR analysis we prepare for the Indian entity. So the documentation which is prepared in a robust way, this will be the best to defend the position of no PE. So that's it from my end. Thank you, and back to you, Uday sir.
Thank you, Heto, for this wonderful analysis, the FAR versus the formulaic approach, and that's going to be the key going forward. We'll see how the pillar 1 finally emerges, because OECD still believes FAR is finally the TP attribution or PE attribution rule, and it does cover the market or a demand. That's the disconnect between India and maybe the developed countries, but we'll see as it emerges. Let me move to Jainesh. Jainesh, give brief aspects about how the TP has evolved and what are the issues more on the practical side in India before we then move to the global quickly. Jainesh, over to you.
Thank you, sir. Thank you for the introduction. Thank you, Hitav, Rutuja, for sharing their insights on various important subjects which are much more relevant in India too. Now, before going into the discussion regarding the recent trends and developments in India, it is important to understand the TP regulation which is applicable in India now. India has almost completed around 21 years for the transfer pricing provisions, and currently the regulation incorporates perfectly the definitions of related parties, definitions of the transaction, the litigation mechanism, benchmarking mechanism, and over the years India has evolved and gained maturity on various issues, and thereby it has been becoming a key for various MNCs to address their transfer pricing litigation in India. Now, as we recently seen that IMF has issued a report which has said that India is a favorable jurisdiction and it is growing fantastic well in comparison to other important jurisdictions such as China, USA. And also, if we have seen other reports, India is seen to be a best country for investment. It is in terms of business, in terms of growth in the investment. Many MNCs are looking India favorably, and there is too much of inflow and outflow of investments from India. And when it comes to India, it is now looked upon as a manufacturing hub, so IT hub, and therefore various companies are being set up in India. Having increased in the FDI and ODI, there is also an increase in the cross-border transactions, and therefore the transfer pricing compliance becomes key for all the companies, and therefore after compliance, it is key for all the companies to justify the transaction, the benchmarking analysis to the revenue authorities in India. Now, as far as compliance in India is concerned, it requires transfer pricing certificate, transfer pricing documentation, master file compliance, country by country report compliance, and all these things prepared in a robust way, linked with the substance, linked with the reality, will always help the Indian companies to safeguard their litigation, safeguard oneself from the litigation. Now, KNAV has been for front runner, as Uday sir told, that KNAV has been in the front runner, and it is being doing compliances for various companies in the IT sector, chemical sector, engineering sector, ITES sector, and therefore it has now grounds to not only undertake the compliance, but to play a key role in justifying the transaction which is already benchmarked, and explain the revenue authorities that the approaches adopted by the Indian companies are in line with the law as well as the judicial positions adopted in India. Over the years, India is also known for its litigation approaches, which are aggressive and also regressive. And we have heard the judgments regarding Vodafone, SR, Shell, etc. And therefore, India was considered as a country where litigation is being treated very difficult, and the revenue authorities are considered to be difficult for understanding the approaches adopted by the taxpayers. However, recently the government of India and the administrators have undertaken policy changes so that the litigation process is streamlined. It is made easy enough so that it can gain the confidence of the investors, give confidence to the taxpayers, and basis that certain mechanism has been brought into the law so that certain friendly approaches are adopted and the litigation process is reduced. As far as Government of India initiative is concerned, the important measures which are brought in includes multilateral agreement procedure, advanced pricing agreement, safe harbor. Now, these are the dispute resolution mechanism which are brought in to also support the taxpayers, that they well in advance discuss with the authorities, give their submissions, and basis that get into the agreement with the authorities itself, so that no litigation can be faced later after the transaction is already undertaken. Again, MAP is a procedure where two government authorities are involved, and thereby it could be a lengthy procedure and cumbersome. However, the APA facility is also very much looked upon in India, because it enables the Indian company to get into the agreement with the government authorities in India, and thereby fix the margin, and if it can, and as for a certain period, it can safeguard itself from the litigation process and the blunt which generally faced without APA, and even if the benchmarking analysis is justified properly. Again, Government of India has brought in safe harbor provisions in the law, wherein which is applicable for the certain transaction of IT sector, ITES, knowledge process outsourcing, business process outsourcing, and lending and borrowing transaction, corporate guarantee transaction. And if the taxpayer wants to opt for safe harbor, and if it is following the rates provided under the safe harbor, it will not be questioned by the Government of India, and that's how it can safeguard oneself from the litigation process again. Again, as part of the litigation streamlining process, faceless assessments and appeals has been commenced, and in this process, the taxpayer or the authorized representatives of the taxpayers are not required to visit the offices, explain physically all the transactions and benchmarking analysis, documentation maintained. However, the online facilities are available, thereby reducing the timelines of the litigation process, and moving smoothly over with the objective of reducing the litigation and making India a friendly country for all the taxpayers. Again, though initiatives are taken by the Government of India or the administrators, however, it is also important on the part of taxpayers to be in line with the jurisprudence, and therefore we have seen that in India now many Indian companies, especially high transaction companies, high transaction value, planning their transactions well in advance so that they are in line with the positions which are currently adopted, and they are in line with the market prices which are currently prevailing. And the important transactions which are generally planned in advance are IP related transaction, software support transactions, sale of goods transaction, distribution transaction, limited risk distributor, limited risk service provider. So here the Indian taxpayers are known well in advance regarding the TP regulation, the price at which the transaction has to be undertaken, and so on. And here KNAV has been front runner again in helping the Indian companies to frame their transfer pricing models, transfer pricing structures, intercompany agreements, and that's how it has been helping Indian companies to avoid any kind of questions or litigation in future. Again, the models, the Indian companies are also seen revisiting their old transfer pricing structures or the remuneration policy, just to see whether the function assets and risk analysis which was undertaken in past is in sync with the current actual function assets and risk analysis, whether the remuneration model is being correctly followed even in current years, considering the recent jurisprudence, whether the substance requirement has been fulfilled. And that's how many taxpayers has been approaching us to revisit their models and help them in bringing their FAR situation, substance and remuneration models in line with the current position applicable in India. So this is about the recent trends and development in India regarding more on litigation front and planning front. And again, compliance is always applicable. So that is it from my side. I think over to Uday, sir.
Thank you, Jainesh, for providing a broad overview of the trends and development in India. Let's go a little global from here. Pratik, with your experience, why don't you just give us an overview of the global transfer pricing, more the trends in USA that may help the US taxpayers. Over to you, Pratik. Yeah.
Yeah. Thanks, Uday. So can you please move to next slide? Yes. So recently, the US government introduced Inflation Reduction Act, which aims to provide around $80 billion to IRS to be distributed over the period of 10 years. Now, this additional funding will be used for improving operational efficiency of IRS, business tax modernization, and taxpayer services. Now, out of this 80 billion, around 45 billion is targeted specifically for enforcement. Additionally, IRS is also planning to hire around 87,000 agents. So we can expect that in coming years, you might see aggressive audit from IRS, especially on the cross-border transaction. So even before the passage of this act, the IRS had announced that it is aiming to expand their audit coverage, not only by increasing audit for the taxpayers, but also identifying additional issues for the taxpayer that are already under the audit. So now, what does this mean for multinational enterprise? I mean, how it is going to impact multinational organizations? What changes are we going to expect in coming years? So I mean, while it will be too premature to say this, but again, one thing is for sure that that the IRS focus will continue to be the cross-border transactions, and we might see very aggressive audits by the IRS. Now, the next point is 15% corporate minimum tax. So again, this act also introduced 15% minimum tax for the large corporations on the adjusted financial statement income exceeding certain threshold. So after the Tax Cuts and Jobs Act, I think this is one of the biggest move by the US government, because although the tax rate in US is around 21%, but very few corporations end up paying an effective rate, which is more than this. So again, this law will again a lot of many organizations, many MNEs will come under the purview of this law. And with this law, I think foreign entities having business operation in USA will be forced to closely monitor their annual profits that they retain in USA. And it will be, I think, a good opportunity for them also to relook at their existing structure, or at least revisit their TP study, TP policies, to make sure that their book profits do not exceed the prescribed threshold. Now, the next point is on, again, IRS has recently won a few, cases. So they are on a winning streak. And so this, again, this is going to encourage them to audit more and more taxpayers and more issues, especially in the transfer pricing area. Also, in the recent priority guidance plan, the IRS has increased several, introduced several regulatory projects under Section 482. So this shows that, that for next several years, the IRS focus will continue to be the TP audit. I'm stressing more on TP audits because that's what we are going to see in future. Now, again, during COVID period, IRS has provided various support to the taxpayers. Various subsidies have been provided, various relief packages have been announced, and various incentives have been provided to the taxpayer. Now, since the sales number are at par with the pre-COVID level, I think that the tax authority would want to increase their share of revenue to meet their fiscal deficit target, and thereby making a transfer pricing a key focus area for the tax audits. Now, again, the focus of IRS is more on substance. They would want to know, where exactly the contractual allocation of risk is. And whether the actual conduct is in line with the contractual allocation of risk. So they are more interested in understanding the actual conduct of the business, whether the party has, party to the contract has capacity to bear that risk, or whether they are playing any role in the management of such risk. So in short, IRS is looking whether taxpayers exercise managerial or operational control of the business activities. Now, historically, the audits, IRS audits were targeting a few selected payers, or I would say a large taxpayers, large MNEs. But now their focus has now shifted to, instead of picking up taxpayers, now they are picking specific issues. So just to give you examples, in recent past, we have seen that the IRS is challenging, limited risk service providers incurring losses, because as a limited risk service provider, you cannot incur losses. They are expected to earn certain profits unless you have, a specific reason to justify those losses. Now, another reason would be the intra-group financing services. Now, here the IRS is more interested in knowing whether the borrower has capacity to bear the risk, whether the borrower is able to, borrow money from any third party. If not, whether that debt can be characterized as equity or not. And again, so that's why it is very important for taxpayers to kind of maintain a contemporaneous TP documentation justifying why their transactions are at arm's length, whether whatever policy that they have adopted, whether that arrangement is meeting with the local requirement or not. Now, post implementation of BAP section plans, now tax authorities has more and more information. They can any country can share information to other country. So before even they send you the notice for transfer pricing, they have sufficient information with them. They exactly know what you are filing in other country. They know what position you have taken in other country. Now, accordingly, before you respond to the IRS or any tax authority for that matter, you need to see, you need to make sure that your whatever response you are giving to authority, that is in line with what you have already submitted to other tax authorities. Now, again, with various factors like geopolitical tension between Russia and Ukraine, rising crude oil prices, and disruption in China. So all these economic factors have led to US inflation hitting 40 years high of around 9%. Again, the 10-year US bond yields are also above 4%. As a result of this, there is a constant pressure on MNEs, especially those operating under a cost-plus model, to control that risk. So that's why since there is a pressure on the MNEs to control their cost, they might want to revisit what their existing TP policies. Next slide, please.
So I think you make a very important point, Pratik. Just one point is about the conduct that you spoke about it. Now it's not only going for the purpose of transfer pricing, and this is globally, and it's good that you made that point. It's not only the legal agreements which are being just floated between the two associated enterprises, and that was an end of it. The BEPS clearly says what is important is your actual conduct.
Correct.
So legal agreements are not going to be relevant beyond a point. And actual conduct, value creation, you said substance, these are all parts of the BEPS regime together with transfer pricing, which will really become, and in your experience briefly now on the challenges and the administration, that would be very relevant, Pratik. Yeah.
Sure. So for the IRS has been taking this constant position, especially in case of a contract manufacturing, that the foreign affiliate is a routine manufacturing entity, and it is not creating any kind of valuable intangibles for the group. Hence, it is entitled for a routine return, or and all the residual profits now should go back to US. So, but this argument often gets rejected by the tax courts. But what we have seen is that IRS is starting to get momentum on this position, and recently they have won 2 cases on this grounds that that contract manufacturing entity should be compensated on a cost plus basis using comparable profits method. So again, this will also encourage IRS to audit more and more clients here. And with respect to cup or cut, so what now we have started seeing is that IRS is more closely monitoring what kind of comparable you have selected, whether those comparables are meeting the comparability factors which are outlined in the US regulations or not. So they are asking more and more questions on that. So they are challenging your comparables as well. So for taxpayers, I mean, so before you even select the comparable companies or the or agreements or any transactions, what you need to see is whether those agreements are really comparable to the tested party or not. Now again, as I said earlier, for a limited risk distributor or a service provider, if they are incurring any losses, IRS is challenging this position. So they are more interested in knowing whether this loss is due to intercompany pricing or due to other reasons. So if it is due to, let's say, due to COVID-19 or any other economic reason, you need to document those reasons in your transfer pricing. That's where a TP documentation plays a really important role. And it has to be on a contemporaneous basis. So as and when you are entering into transaction, you need to document those reports. Now on business restructuring, again, so with increasing M&A activities, we have seen a lot of business restructuring taking place. So IRS would want to know, whether any exit charge is required if you are restructuring your business, if there is any change in supply chain. So whether any buyouts or any exit charge required. So so taxpayer should clearly explain all the changes and the rationale for new TP arrangement in the TP documentation. Now on intra-group service front, again, so there are 3 tests needs to be done. One is need test, benefit test, and rendition test. So when I say need test, whether there is actually a need by the recipient entity for this kind of services, what kind of benefits they have received from availing of these services, and whether these services are actually being rendered by the the parent entity or the headquarter entity. Again, here the questions will come on duplication of services or whether any stewardship functions being performed. If there is any stewardship activities being carried out, those activities should be excluded from the cost base. And finally, on the allocation key, what kind of allocations key taxpayers have used, whether those allocation keys are scientific or ad hoc percentage, and they need to get justification on that. Now on intra-group financial transaction, again, I mentioned this earlier as well, whether the borrower has capacity to bear the risk, what is the credit rating of the borrowing entity, whether the interest rate that is charged is in line with the the market rate or not, whether there is an explicit or implicit support provided by the parent entity, whether the taxpayer or the borrower has maintained adequate debt to equity ratio or not. And finally, if the borrower does not have the capacity, then the transaction may be recharacterized to equity. So these are the factors that MNEs should take into consideration before they avail any financial support from their related party. And the next point is on IP again. So I think Janesh already discussed this point, but again, IRS is more concerned about the valuation, whether the taxpayer has obtained any valuation from third-party service provider or not. If not, if yes, then whether the assumptions that are provided in the report, those assumptions are correct or not, and whether the taxpayer has conducted DEMP analysis or not. And finally, on the cost contribution arrangement, so whether allocations have been made based on reasonably anticipated benefit ratio or not, because generally in this kind of arrangement, allocations are made based on the the anticipated benefits that you are expecting out of this arrangement in future, and whether your ex post returns or the ex post outcomes is in line with ex ante assumptions that you have considered. If not, if there is a significant deviation, then you need to provide reasoning whether why those assumptions were incorrect, or what made this the assumptions so different. I mean, why there is so much difference in the ex post and ex ante returns. So yeah, I think these are the key challenges, I would say. Over to you, Uday.
Thank you, Pratik, for giving an excellent overview on the global side, particularly the USA. Let me maybe ask you a question, since we spoke of India, we spoke of USA, and something global. Any experience in your view? You've done a lot of global studies. Any specific country, just to give a flair to the people?
Yeah, thank you, Uday sir. So my recent experience is in relation to the tax audits for Singapore, because Singapore is a country where a lot of companies have stashed their businesses and the headquarters, and it so happens that because of the oversight, or probably the audit team would have not make this trigger to the management, there is a lapse of preparation of the transfer pricing study report at Singapore level. Because 2 years back, Singapore tax authorities have come with a circular saying that if there is a gross revenue turnover which is crossing Singapore $10 million, so in that case a transfer pricing study is required. There is another condition which says that if in past TP report was supposed to be prepared, then they have to continue preparing it in future years as well. So here there is a catch where an entity forgets to prepare the transfer pricing study report, say in year 1, 2019, where the turnover has crossed a Singapore $10 million. They have left preparing the TP study report. It may have not come out in the health checkup, or probably the audit team would have not identified. And in subsequent year, will what happen? The threshold is not met, which is within Singapore $10 million. But then they take advantage of second condition, which is last year TP report was not prepared. So even I am not supposed to prepare in current year and future years. So here lies the catch. And in one of the recent client case where the Singapore authorities, tax authorities identified this issue, and the client has to then prepare the TP report for last 4 years. So there is opportunity for everyone over here, maybe partners and as well as the business heads, to have a regular routine checkup every 2 years or 3 years to see whether there is any lapse or not. Otherwise, there are huge penalty implications and so and so forth. There has to be some kind of a self-regulatory risk, which is also there. Over to you, Uday sir.
Interesting. Though the TP is a global law, each country has its own nuances, right? So we have in India, if you have a transaction of more than 1 crore, which is about now today's dollar term $120,000, $130,000, you need to maintain documentation. Here you are saying $10 million. So I think each country has its own nuances, and it will be good for the tax directors to just keep track of that. My final question, To you, Rutuja, we started with BEPS, Pillar 1, Pillar 2. As the authorities have set out a timeline of 2024 to start with January 2024. And there have been a lot of discussions. What's your take? Is it going to happen? Is it ambitious, or in very brief?
Yes. So, yes, OECD is ambitious about implementing both Pillar 1 and Pillar 2 by 2024. And the world is actually reacting to this. As you may be aware, UAE has already introduced corporate tax of 9% with effective from January 1st, 2024. UK is planning to introduce domestic minimum top-up tax. Singapore, in its budget of 2022, it has introduced the concept of minimum effective tax rate. Ireland, Mauritius, EU countries, Switzerland, all are planning to implement these rules in view of global Pillar 2 specifically. With respect to Pillar 1, there is a difference in the opinion, because USA is in not much of favor of implementing Pillar 1. So there are discussions going on whether Pillar 1 will be implemented without if there is no consent of USA, how it will get implemented. So those discussions are going on. So let's see what happens next. But in my view, OECD is ambitious, expecting throwing all the rules, regulations in timely manner. So hope for the best.
Yeah, and I think it will also need changes in the domestic tax rules per se. So interesting take. But yeah, this is going to stay. It may be a year here and there. But certainly, in my view, if last 25 years were in international taxation, looking at the tax treaty and planning, next 25 years will be Pillar 1, Pillar 2, and the transfer pricing, of course, put together, and so on and so forth. So yes, with this, we possibly have given you a broad overview of all these issues together. I want to end the session by thanking Pride Partners again, and my colleagues Hetav, Pratik, Rutuja, Jainesh, and also Anurag, who is on a back end, has done a lot of work. Thank you, all of you, and thanks to all the participants for patient listening. We end the session here. Thank you very much.